So good afternoon, everyone. Welcome for joining the webinar today to learn about the upcoming Lion-Nomura Japan Active ETF. So Lion Global Investor is a well-known ETF issuer in Singapore, and I believe that those investors who invested in Singapore market before are sure hear about their ETF, such as the Lion Phillip Singapore REIT ETF, Lion OCPT Security Hang Seng Tech ETF, and others. Today, we are honored to invite Mr. Ong Xun Xiang at the Lion Global Investor to share with their upcoming Lion-Nomura Japan Active ETF, which is powered by AI and is also the first active managed ETF in Singapore. Sound interesting, right? With the idea of the AI and also the Singapore first active managed ETF. So, if you guys have any question during the presentation, please feel free to type out at the Q&A below. And without any delay, let's welcome to Xun Xiang.
Okay, thank you, Ruben. Okay, let me share screen. All right. Okay. Good afternoon, everyone. Thank you for joining us today, and thank you to Jason, Ruben, Muming, and Marino for inviting me here today. I'm Xun Xiang from Lion Global Investors, also known as LGI, and you can call me LGI's ETF guide. So I'm here today to share about the smarter way you can use to invest in Japan. And during our session today, I will also share the fact that this will be Singapore's first active ETF and also Singapore's first AI-powered ETF. And before I dive deeper into the specifics about this ETF, maybe let me first briefly introduce LGI to everyone. So LGI, we are part of OCBC Group and also one of Southeast Asia's leading asset managers. So as of the 31st of December, we managed up to 70 billion Sing dollars of assets for our clients. So, and besides being the asset management arm, OCBC Group also has the insurance arm, which is Great Eastern, and also the private bank arm, which is the Bank of Singapore. And we started our ETF journey more than 6 years ago when we first launched our Lion Phillip S-REIT ETF with PhillipCapital Management, which is part of the Phillip Group, together on the 2017. So back then, that was where we started our ETF journey. And between 2020 to 2022, we listed 3 ETFs within 18 months, and that propelled our growth forward to become one of SGX's top 5 ETF issuers. So as of today, right now, what we are launching will be our 5th ETF, which is the Lion-Nomura Japan Active ETF. This will be the only AI-powered ETF that will be listed on SGX, and also the first active ETF that will be listed on SGX on the 31st of January. So right now, this period is the initial offer period where we are open for subscription for this specific ETF. And with support from investors like all of you, together with myself included, we grew our AUM within 6 years from 0 to 815 million. And our ETFs are also within the top 10 ETFs held by retail investors based on SGX data as of the 31st of December. And if we zoom further into the segment of SRS investors, our ETFs are also within the top 10 ETFs held by SRS and CPFIS investors. So all these demonstrate that LGI, we are strongly committed to launching quality ETFs for the Singapore market and the Singapore ETF ecosystem. And that is why we collaborated together with Nomura Asset Management to launch Singapore's first active ETF and Singapore's first AI-powered ETF. And this will be our Lion-Nomura Japan Active ETF powered by AI. And before I talk, because there are numerous aspects of this ETF which I will cover. So basically, I will break them down into 3 key aspects. The first would be about why Japan. The second would be why an active ETF. And third, why is it AI powered? So I'll touch on this first section and discuss why Japan first. So in terms of why Japan, some of you might already have recently returned from your holidays from Japan. Japan is a country well known for its rich tradition. So as you see from the Shinto temple, and Japan has thousands of years, centuries of cultural heritage that started way long ago. Japan is also a country well known for tourism. I mean, we go Japan, visit Mount Fuji, visit Sakura, and Japan is also as well known for its cutting edge technology, especially in the aspects of semiconductor chips, pharmaceuticals, and also AI. And not to forget that Japan is also an economy that is too big to ignore. So to put into perspective, within the Asia Pacific, China and Japan are the largest economies within this Asia Pacific continent. And we rank by the world's GDP in terms of our nominal GDP. Japan is also the world's fourth largest economy. And among the G7, which is a economic body made up of the seven largest economies in the world, Japan is the only APEC member in the G7, which has been consistently dominated by a lot of Western countries. So with a lot of geopolitical situations happening now, for example, like the US-China tensions, the Israel-Hamas war, and Russia-Ukraine war, Japan will be much more favorably positioned to navigate a lot of all these geopolitical situations. And in terms of the stock market performance, Japan has also recently rose from its 33-year slumber. So maybe to put into some perspective, within the past 6 years, from 2017 to 2023, topics only rose 56%. But as you see here, right, in the year of 2023, which is just 1 year alone, topics rose 25%. So that means 40% of the growth for the past 6 years happening within 1 year. And that made Japan the best performing Asia Pacific market in the year of 2023, where it outperformed our Singapore's STI and also the MSCI All Countries Asia ex-Japan Index. So as you see here. And all these are happening because structural catalysts are favorably positioning Japan for growth. So I'll cover the 3 key catalysts about how all these make Japan a long-term and attractive growth story for a lot of investors. So first catalyst would be about corporate governance, which traces its roots back to Abenomics back in 2012. So back then, Abenomics had 3 key policy arrows. The first was on monetary easing, second was on flexible fiscal policy, and third was on structural reform. And this was the longest term policy driver among Abenomics' 3 key policy arrows that was first started back in 2012, more than 10 years ago. And specifically in one of former PM Abe's final speeches as PM, he specifically mentioned that he will break down any and all walls looming ahead of the Japanese economy. So right now, although PM Abe has passed on, this remains one of his key legacies because his reforms and policies have driven long-term structural change within Japan since 2012. So maybe some examples. Around 10 years ago, the corporate governance reforms already started based on the stewardship code, which was started in terms of the reform. And then after that, for governance code, this was further reformed back in 2015. And in recent years, for example, April 2022, the Tokyo Stock Exchange also further restructured its market segments into prime, standard, and growth. So it's a bit similar to what you see on the SGX, where you have main board and catalyst. But in Japan, it's a very conservative country where actually most I would say company CEOs or chairman, they value means a lot. So all of them actually want to be in the prime and try to avoid being in the growth segment. So because of that, this created a lot of impetus and momentum for a lot of Japanese companies to implement a lot of capital efficiency plans, so to grow their market cap. And in 2023, another change happened where the Tokyo Stock Exchange also finalized its market restructuring rules. And there's one key rule which required and directed Tokyo Stock Exchange listed companies to comply or explain if they trade below price book 1. So all these are important because it created a lot of emphasis and also impetus by a lot of Japanese listed companies to create more capital deployment plans, increasing share buybacks to help increase the share market prices, increasing dividend payouts, and also further improving in terms of corporate engagement. And one thing to take note here, I mean, this will be the point I would that what I would say be more connected to the later part of the presentation, it would be that the small mid caps within Japan, a lot of them are more likely to trade below price book one. So because of this, they could benefit more from all these corporate governance reforms. So this is the part about the first catalyst, corporate governance reforms. The second would be about the positive impact of inflation. So as I previously covered, monetary easing is one of the policy arrows of Abenomics. So Japan has maintained an ultra low interest rate for decades, with some years even hitting negative interest rates. So all these are important because low interest rates help to encourage lending, encourage consumption, which help to initially drive inflations and also drive up company valuations. And this year is a special year for Japan because last year we have already seen Japan topics rising 25%. Nikkei 225, for example, in the early part of this year already hit another 33-year high. So a lot of people are asking whether Japan has further room to grow. There is, because this year, in fact, in this month alone, the Kishida administration within Japan is also launching new NISA program reforms. So NISA stands for Nippon Individual Savings Account. So it's a bit similar like our CPF and SRS. And all these are expected to unlock 9 trillion worth of domestic purchases in Japan equities in the next 5 years. And furthermore, for the Kishida administration, they are also looking to finalize the corporate pension reforms by the end of this year. So all these could even unlock more 12 trillion more yen of domestic purchases by institutions into Japanese equities. So if we sum these two up, all these add up to more than 20 trillion yen worth of Japan equities purchases by the institutions and also individuals in the next 5 years. So all these are one aspect that will further drive up inflation within Japan. And within Japan, the labor market is also more rigid these days. But because of inflation, this could also help further drive increase in wages. And all these could help further lubricate the labor market we see now. And all these confluence of factors are important because they could help drive up company valuations within Japan. So this basically covers the second point on inflation. So the third point would be about foreign investors' reallocation towards Japan. So in 2023, this whole year alone, we have seen 3.1 trillion worth of foreign purchases of Japanese equities. So the key person who started this trend within buying of Japan would be Warren Buffett, started accumulating Japan exposure back in 2020 when it was the COVID pandemic year. So back then, he started purchasing and building his positions into the 5 Japanese trading houses, which are the Sogo Soshas, that are very omnipresent within Japan and own many different kinds of assets. So all these were important because Warren Buffett rarely invests overseas. And by investing in Japan, this attracted a lot of foreign institutional investors' interest. And then after that, their reallocation towards Japan. So all these made Japan an interesting market, which a lot of different investors didn't used to look at within Japan. So with all these confluence of factors, in 2023, Japan also seen rising foreign investor interest within the market. So right now, the next part would be, after covering the 3 catalysts, right? Corporate governance reforms, inflation, and also foreign investors' reallocation towards Japan. The next question a lot of readers or investors might ask is whether it's still at an attractive entry point or even good entry point right now. So if we compare to the other markets, for example, like US and India, Japan right now in terms of PE ratio is at 13.4, which is still very close to its 10-year average compared to US and India, which are already way above their 10-year average. And if we look at Japan in terms of price book ratio, is still very near in terms of this price book ratio. But if we look into, for example, US and India, they have been significantly above the price book ratio. So all these are important because remember the catalyst I talked about in terms of the NISA reforms, which will drive inflation, being expected to drive more than 20 trillion yen worth of Japanese equity purchases. All these are still long-term catalysts. for the next 5 years. They still take a lot of time to be priced in. And so because of this, with all the tailwinds at the back of Japan, and also more foreign investors purchases expected of Japanese equities, it is still at an attractive entry point right now in terms of valuation perspective and also in terms of future growth potential perspective. And there's also one bonus factor, which is about a potential JPY rebound. So within the last 6 years, right, for USD and Sing dollar, they have risen and appreciated around 20% and 32% against the Japanese yen. But in 2023 alone, US dollars and Sing dollars appreciated around 8% and 10% respectively against the Japanese yen. So this means roughly more than around 40% in terms of the appreciation happened within 2023. I mean, when foreign currencies appreciate against Japanese yen, this means the Japanese yen relatively weakened. But this year is also known to be and expected to be the year of US rate cuts, and also a year where the Bank of Japan could potentially tighten its ultra loose monetary policy. So all these could lead to the yen strengthening and catalyze a potential JPY rebound. When there's a potential JPY rebound maybe happening that could happen in the next few quarters, when the yen is still weak now, this could add further currency returns if you start accumulating Japan exposure right now. And with all these, that's why Lion Global Investors and Nomura Asset Management decided to combine our strengths together to create an ETF of multiple firsts. And this ETF will be focused on Japan because this will be the only Japan-focused ETF that will be listed on the SGX in the 31st of January. So after its listing, the only way if you want to buy SGX ETFs to gain Japan exposure right now will be through the Lion-Nomura Japan Active ETF. And this ETF is also an ETF of multiple firsts because it will be Singapore's first active ETF and also Singapore's first AI-powered ETF. And we are collaborating with Nomura Asset Management because of a few key advantages they have. They are one of Japan's top asset managers by AUM due to the very deep Japan expertise they have. They're also one of Japan's top ETF issuers with a 43% market share. And they also established their AI innovation lab more than 6 years ago and have already launched AI-powered funds for institutional mandates. And that's why after that, we decided to work further with them to use AI to power investments, not only for institutions, but also for the mass market like you and me. In terms of LGI, we are also one of Southeast Asia's leading asset managers. We are one of the SGX top 5 ETF issuers. And we ourselves also established our artificial intelligence of investments team more than 2 years ago. And we are currently supported under the MAS AIDA scheme since 2022. So all these help us collaborate together with Nomura Asset Management based on complementary philosophies and capabilities. And I've explained about why Japan, so maybe the next part would be about why in the form of an active ETF. So until now, as of right now today, all the ETFs listed on SGX are passive ETFs, or we can call them index tracking ETFs. So there are some fundamental differences. So passive ETFs, they track a benchmark index. And so because of this, they are sometimes more constrained by the index rules and index methodology that are set by the index provider. So this can be creating a lot of constraints, especially for indices that were built very long ago, for example, in the 1950s or 1960s. Because of these, a lot of indices may not be that flexible and accommodating to market changes. But if we compare to active ETFs, active ETFs mainly just use benchmark indices for performance comparison purposes. And they are not using the benchmark index to replicate their performance, unlike a normal passive ETF. So because of this, there's greater room. They are less constrained. So much greater room for them to outperform the broader market. And within the global landscape, right, within the last 6 years, we have seen the global AUM of active ETFs growing more than 3 times to 412 billion as of Q1 last year. And within the past 3 years, we have also seen increasing portfolio allocations towards active ETFs. So for example, to put into perspective, 1% of global investors used to allocate just more than 40% of their portfolio towards active ETFs back in the COVID pandemic year, 2020. But in 2023, as of July, this number actually grew 14 times to 14% of global investors allocating more than 40% of their portfolio towards active ETFs. So within the global ETF industry or the landscape, it is a growing trend. And for investors like you and me, if we invest into active ETFs, we are investing into a growing trend. And this is because there are a few key advantages active ETFs can offer compared to traditional active funds or even the usual passive ETFs. So on the first part, there's greater liquidity offered by active ETFs compared to traditional active funds. And that there are some reasons because there's real-time pricing and also intraday trading allowed for active ETFs. The second part would be more on cost efficiency because active ETFs, they do not have a distributor. So there's lower cost and more efficient access to precise exposures. So in terms of cost perspective, in terms of management fees, because there's no distributor fee paid for active ETFs, it's a lot more cost efficient for the end investor like you and me. And the third, compared to passive ETFs, active ETFs are much more constrained because they do not track a benchmark index. So all these give it much more room to outperform the broader market. And all these give the active ETF greater speed and flexibility when reacting to the various market changes. And what's more, we are Singapore's first active ETF. And the third, in terms of my sub-point about my presentation, would be about why is it AI powered. So we have seen AI being hugely covered and increasing use within our industry. So a lot of us already heard of ChatGPT. In terms of our daily lives, we have seen the use of AI within self-driving cars, for example, by Tesla, by Toyota. In our iPhones, we have Siri inside, and Siri is also an AI. Within our smart homes, we also use AI to monitor appliances usage. And within the area of healthcare, we have in fact already started seeing AI being used to perform simple surgeries. I mean, of course, we have it supervised by human surgeons to ensure the proper risk management involved. And this part about human supervision is important, which I will cover much later. And so because of all these, beyond our daily lives, AI can also be used for wealth management. And there are few key advantages of AI over why AI can be important and can be efficient and help effective investments. So first point would be about capacity, because AI can work much faster than humans. They have greater capacity. They can evaluate hundreds of factors for security selection. So I mean, after being in the finance industry for like around more than 10 years, I mean, in terms of what a normal human analyst, what they can do, at most they can analyze 30 to 50 stocks. But in terms of AI, the capacity is much bigger because as long as you feed it with more and more data, it will grow and grow further. So there's greater scalability. So this is the first part about capacity. The second part would be about AI being able to learn iteratively. So it's important because when new market data is fed into AI, they are able to react to the latest changes, latest data, and also respond to trends much more dynamically. And the third point would be about AI being disciplined. So because of this helps it avoid human bias and also human emotions when making investment decisions. So all these help the ETF identify quality stocks more efficiently and also invest more effectively. And what's more, we are also Singapore's first AI-powered ETF. So right now at this stage, I've covered 3 key broad points. First would be about why Japan. So there are the 3 key catalysts: corporate governance reforms, inflation, and also foreign investors' reallocation towards Japan. I've covered about why AI powered earlier because of the few key advantages: capacity, dynamic, discipline. And I also covered about active ETF, the broader active ETF landscape, because, for example, one key point would be the global AUM of active ETFs growing more than 3 times within the past 3 years. So right now, what we have is actually an ETF that's able to connect all these 3 points together. Why Japan? Why active? And why AI powered? Into the Lion-Nomura Japan Active ETF, powered by AI. So this ETF has also 3 key features summarized nicely into AID on how it will aid your portfolio. The first point would be about actively managed, because this ETF focuses on the top 50 to 100 Japan-listed companies with high capital appreciation potential. The second part would be about it being intelligent, because AI can work much faster than humans and evaluate hundreds of factors for security selection. And third point would be about dynamic, because the AI models are refreshed monthly and the portfolio is rebalanced monthly. So all these allow it to respond to trends much more dynamically. And all these 3 factors come together to aid your portfolio in terms of how to be able to assess quality Japanese stocks. And this is a brief overview of the investment strategy. Basically, in substance, AI models are used to choose stocks after evaluating hundreds of factors. It follows a 3-step security selection process. So the first step would be there's a base of 1,000 stocks, 1,000 Japan-listed stocks, based on the past 6 months liquidity. So this will form the base of the 1,000 stocks. The next step would be having the AI models come in. So the AI models evaluates hundreds of factors to assign scores to each of the stock within this 1,000 stocks to produce the ultimate model portfolio. And then after that, in the end, what you see is a model portfolio consisting of 50 to 100 Japan-listed stocks. And there's the human supervision part that will also come in here, because it's also important to have to evaluate for the portfolio manager to evaluate based on portfolio sizing. So we do not 100% rely on AI. There's the human element that comes in to perform risk management in terms of portfolio sizing based on criteria such as size, volatility, and weight. So this is the more technical way of explaining things. I also have a more easier way and more day-to-day, daily life kind of way to explain this whole concept. So imagine you go to Don Donki. You see 1,000 things on the shelf. How do you decide what to buy? I mean, if you are a human, probably you have to go shopping. Maybe you look at what each of the 1,000 things on the shelf. Or sometimes because of time, you might not be able to look at 1,000 things on the shelf. You just look at, maybe you just do sampling. And what if right now you have an AI assistant that can come in? This AI assistant knows your preferences very well. The AI assistant comes in to score each of the items and then rank them and sort all these 1,000 things on the shelf. And in the end, give you and recommend 50 to 100 things for you to buy. So that's cool, right? So in the end, you have 50 to 100 things recommended by the AI to buy. But because you didn't tell the AI model about your budget. So because of your budget or your other key requirements, because sometimes inside the AI, they just record new and incorporate newer information, but you just didn't tell the AI because you want to have the ultimate say, you want to be the ultimate decision maker to eventually buy what you need, dependent on your own personal preferences. So that's where the human supervision and human expertise part comes in, because you provide your own contextual judgment that the AI doesn't have. So you provide your own contextual judgment to the AI recommendations of 50 to 100 stocks. So maybe you trim some of the weightings. Maybe the AI recommended 50 to 100 different kinds of things. Maybe some of the food, maybe like bonito flakes, you actually don't need. You can just cut down. You have enough at home for your kitchen. Maybe you don't need some things, but maybe you need more soy sauce. So that's where the human element comes in to provide the final fine tuning, and that is where portfolio sizing is about, where you come in and perform final fine tuning. And that is the whole broad concept about this ETF. You have 1,000 things on the shelf. The AI assistant comes in, does all the heavy lifting to do analysis of this 1,000 stocks that were inside the universe. They do the ranking, the sorting. But in the end, the human still has to come in because the human has the contextual judgment to be able to see out what he or she truly needs. And in the end, after that, you go to the cashier to check out with the 50 to 100 Japanese listed stocks. So this is basically the broad concept about the Lion-Nomura Japan Active ETF. It's a combination of both AI, which does the heavy lifting, but also the human part, which provides the contextual judgment. So this part is important because the AI does not fully run the ETF. There's the human part that will come in to supervise. And here's what you get in terms of the latest pro forma portfolio in terms of characteristics. So what you see is a colorful mix of various sectors within the ETF that provides the Japan-focused exposure to the entire Japanese economy. So right now, as of mid-Jan, what we see is the financials being a major component of the ETF. Another major component would be industrials. And in terms of market cap, which is what you see here, the large caps, they form the foundation of the portfolio. So a lot, you will see a huge base of large caps, which form more than 50%. But also on the end, you also have the small mid caps, which are the potential alpha or generator of additional returns. So this will be the interesting part, because remember I said earlier in the corporate governance reforms about these small mid caps being more likely to trade below price book one. And these are the exact same these are most of the companies that will be affected by the corporate governance reforms to unlock more value to increase company valuations. And because of this, these are the ones which could have more price and capital gain appreciation. And that is why in terms of the recent most latest makeup is roughly 48% of the entire portfolio. So what you see in terms of market cap and also in terms of sector exposure is a Japan-focused portfolio for this ETF that's diversified across stocks, sectors, and market cap. And here's also a glimpse of the ETF's latest top 20 constituents as of the mid of January. So you see the familiar names, right? For example, like Japan Post Holdings, which is a extremely large diversified financial. You also see Nippon Steel, which is one of Japan's largest steel makers. But in terms of the light blue highlights, you also see some names that are not so familiar outside Japan, but they are actually rather big within the Japanese economy. So for example, one name would be Mitsui O.S.K. Lines, which is actually one of Japan's largest shipbuilders. You also see Mazda Motor Corporation, which is one of Japan's largest car makers. So when we think about Japanese cars, a lot of us think of Nissan, we think of Toyota. But actually, Mazda is also one of Japan's largest car makers within the Japanese economy. So what you see here is a mix of large caps and small caps bundled together within this ETF. And to summarize, the Lion-Nomura Japan Active ETF, powered by AI, offers investors like you and me a convenient and affordable way to invest in Japan. It provides the smarter way to invest in Japan because of three key features. It's actively managed, focusing on the top 50 to 100 Japanese stocks by capital appreciation potential. Second, it is intelligent. AI models within the ETF, our proprietary AI models, work much faster than humans to evaluate hundreds of factors for security selection. And third is dynamic. The AI models are refreshed monthly. The portfolio is also rebalanced monthly. So for some of you in front of your computer right now, please log on to the Podium's platform to search JJJ for the Sing dollar counter and JUS for the US dollar counter to buy this ETF. So these two tickers, the SGX tickers, are important. JJJ for Sing dollar counter and JUS for the US dollar counter. So among them, JJJ actually, for personal preference, is much easier to remember. Because to me, J stands for Japan, and JJJ just brings Japan, for at least for me. So I hope it also stands for Japan and Japan for you. And we also hope you use the smarter way to invest in Japan today. Thank you, and I'll hand over the time to Ruben, who will explain how to subscribe using the Podium's platform.
Okay, thank you, Xun Xiang, for the great sharing. So I believe everyone, you guys have know this ETF well. So if you have any question, please feel free to go to the Q&A below and raise out your question. And then now I will share to you how you can subscribe this amazing ETF through our Podium's account. So can you guys see my screen? Okay, great. So at time you log into your Podium account, and then you can go to the top here, the second tab called account management. Then you go to the online forms here, and then you select this IPO subscription. You click in, and then you scroll to the bottom. So yeah, give me a second. So normally you can go to the counter here and find the Lion-Nomura Japan Active ETF, and then click the apply. And then I think that's all for how to subscribe.